Hey everybody, good morning from Brooklyn. Very cold and still snowed in Brooklyn. And welcome to another video podcast, another edition of the Biotech Capital Compass. This one should be short and sweet. It's a free edition. This is something I've been thinking about for a while, and I'm going to start calling it the Biotech Tape Check series. So essentially, it's a video about what just happened. What are some of the takeaways from what has happened? It's usually during an event, important, time in the year. And then what does that mean for, uh, the biotech, various biotech tapes, whether it's indices or ETFs, large cap all the way to small cap and micro caps. What does that mean coming up? It's really educational in nature, but also I think should be helpful to the astute investor or anybody who pays attention to biotech. And basically, again, our goal here is to really help you first and foremost unpack the current narrative around biotech, what historically has been the case with biotech, because it's got a certain cadence and seasonality that happens in biotech and the tape, and then also once in a while try to identify any surprises. That's not the case this time. So let's get going. End of January is usually an important inflection point for the biotech tape, which is why we're doing this. I published something last year, didn't do a video around it, but this year I thought it was important to do a video. So again, the end of this month is an important inflection point for the biotech tape. JP Morgan is behind us, those series of conferences. Fourth quarter earnings are underway or starting with biotech, late January and into February. And the question now becomes, what just happened? What's coming in February and March? And what does this mean for how biotech trades over the next couple of months? So this really isn't a stock-specific video. It's really tape reading exercise, how to think about biotech. And it's very important, so stay with me, why it's important to understand, JP Morgan and the fourth quarter, around which we actually published a newsletter and a video podcast for our paid subscribers. So, if I had to sum JP Morgan up in one phrase, it would be execution over storytelling. That's really what it was all about. We published a pretty comprehensive newsletter on it, did a deep dive on a set of different, inputs and coming out of JP Morgan. Management teams weren't rewarded for big visions. They were judged on timelines, manufacturing readiness, commercial discipline. Infrastructure mattered a lot. Manufacturing capacity, isotope supply, data systems, AI tooling. These aren't back office details anymore. They're competitive advantages. And again, some of these are for life sciences companies, but we specifically focus on biotech. So capital is still there, but it's selective. Investors want differentiation and a credible path to scale. So again, if you go back to our JP Morgan takeaways note, we identified for biotech companies what was really important. It's actually it was clinical trials, clinical milestones, updates, and then for the larger caps, sales, really a focus on like revenue in the P&L. For smaller caps, also potential for capital raises, et cetera. So again, capital is still there, but it's selective. Investors want differentiation and a credible path to scale. On the M&A front, big pharma signaled caution. Bolt-on, tuck-in, de-risk assets, not splashy bets. And regulatory uncertainty still in the background. Not catastrophic, but enough to keep people cautious. So, we published a video podcast around fourth quarter, what our expectations are. The earnings season, is just getting going, and we expect to reinforce the same message. It should be a tone resetting quarter, less about upside, more realism around cost, prioritization, execution. Guidance or the absence of it, could be a signal. What companies didn't guide too often matters more than what they did. So really paying attention to guidance is going to be important. Large caps, they'll be talking about durability. That's what we expect. Small caps will be talking about survival and optionality. I actually just noticed, Biospace, this is a well-known, provider of they list jobs for biotech companies, all over the country. They also write some really interesting insights. They just published a newsletter saying that, the fourth quarter hiring was actually up in biotech, for the first time quarter on quarter. So does that mean that, we could have a good year for hiring this year in biotech. I mean, I'm keeping my fingers crossed. All of my colleagues out there, I'm hoping to make my business successful, which should, be good for folks reading this and hopefully subscribing. So, it does look like, and at least that's what Biospace is hypothesizing, that based on some, initial trends they're seeing, there could be an uptick in hiring in biotech in 2026. So really, is earnings going to act as a reality check after JP Morgan optimism? 2026, I think, is still going to be framed as like an earn it year, data, revenue, or both, after especially the really big move we had in, the biotech indices and ETFs. So let's talk a little bit about what happens in February and March. And part of this is just what happens seasonality and just some of my takeaways from what I've learned, doing this for 20 plus years now, or actually 20 years, just slightly plus. January is slow for conferences. That's medical conferences, the big investor conference, again, JP Morgan and the series around it. February and March are not. Medical meetings start to heat up in February and March, neurology, infectious diseases, immunology. The investor conference calendar also fills up, starting smaller in February and going full tilt in March. You can actually look these up if you Google investor medical conferences, biotech, pharma, and PDF. You can come up with a listing of these. Previously, Soulberry Trout used to publish a good version of this. Precision AQ publishes a good version of this. They should still be available on the internet if you search under that. And always, feel free to give a shout out to these firms for doing the grunt work here. So, first, bandwidth gets constrained. I'm talking about some important dynamics because of what's going on, with medical conference, investor conferences, February and March. At least for investors, bandwidth does get constrained. Management teams are traveling, sell-side analysts are booked, investors are in back-to-back meetings, February, and March. Second, large cap investors know something structural. Most biotech companies guide conservatively in the fourth quarter for the coming year, and many have a sequentially weaker first quarter versus the fourth quarter. So you actually have a down, for example, revenue. Always mention a good case would be Gilead, which over the last few years has reported 10 to 15%, decrease in its revenues from fourth quarter to the first quarter. This is actually well known. And then third, and this matters for the tape, smaller cap companies tend to raise capital in February and through April, window. Coming out of JP Morgan optimism, a lot of these conferences in February and March where executives and, investors and bankers and analysts are all talking to each other. It's a fecund period for raising monies. And so, that overhang alone can make investors cautious because, companies, when they raise money, small caps, they're dilutive, meaning that they give out more shares. So, their earnings going forward, even if they're losing money, is going to drop, right? So that's just something that investors never like. Now, raising money for small cap biotech companies does increase their cash runway. So it can be kind of a little bit of a positive also. And many times both of those, factors end up canceling each other out, the negativity and the positivity. Again, this overhang of small caps raising money can make investors cautious, as I mentioned, even in companies that are executing well. So put this all together and you often get a softer biotech tape in late February, March, and sometimes April. This is seasonality. We've published on this previously last year, this year. It's already starting to happen. The tape seems to be getting a little bit weaker in biotech. This isn't panic, it's mechanics. The tape is acting very rationally. As I walk you through some of these just broader issues. There's many other issues also going on, that are stock specific, but, broadly speaking. So what this means for the biotech tape. So takeaway here is don't run for the exits. From the biotech capital perspective, the message is stay calm, stay selective, stay engaged. Tape weakness in this period is often rational. It reflects guidance seasonality, capital raises, and conference congestion. As long as we don't layer on new policy shocks, drug pricing, access issues, regulatory surprises, this is a normal digestion phase. Pick your spots, understand the calendar. And remember, biotech rarely moves in a straight line. These are all, I think, important takeaways. So this is one of those moments where context matters more than headlines. We'll keep revisiting the tape as February and March unfold. Appreciate you being here. Thanks for following along. As always, Have a good day, a good Friday. And I know it's cold for many of you out there, and there might be some more slow blizzards coming. My good wishes are with everybody. Stay warm, stay safe. Take care, everyone.